Welcome back to the deep dive. It is Thursday, February 5th, 2026. If you're listening to this on your commute, you might want to grip the steering wheel a little tighter because the markets today, and well, the corporate world in general, are swerving all over the road.
Swerving is a polite way to put it. It really feels like the tectonic plates of the economy are shifting under our feet today.
Exactly. I was looking at this stack of reports we pulled, everything from CNBC and the Washington Post to, the more niche stuff like Legal IT Insider. And the vibe is just frantic. It feels like a high-stakes game of musical chairs happening at the absolute highest levels of business. We've got CEOs swapping seats, massive mergers that sound like science fiction, and then, amidst all of that, we have cheaper potato chips.
We do, and believe it or not, the cheaper chips and the sci-fi mergers are actually part of the same story.
That is a bold claim. But that's our mission today, right? To connect these dots. We need to figure out the link between the drama at Disney and PayPal, the sudden drop in snack prices, and this, well, incredibly complex and frankly kind of messy world of AI mergers.
And we need to get past the headlines. The what is interesting, but the why, that's where the money is. If you zoom out, there's this massive theme running through almost every story we're covering today. Consolidation.
Consolidation.
The biggers are trying to get bigger, and the efficient are trying to crush the inefficient.
Okay, let's unpack this. We have to start with the musical chairs in the C-suite. The biggest name on the board today is Disney. The Mouse House has a new king.
Or at least they finally promoted the prince.
Right. Josh DeMauro, the guy who's been running the Parks division, is officially the new CEO effective March 18. Now, my first reaction was, finally. But looking closer, does this actually change anything? Or is this just the board hugging the status quo because they're terrified of another Bob Chapek situation?
It's definitely a safety play, but, it's a strategic one. You have to look at where Disney's money actually comes from. For the last few years, while streaming was just bleeding cash and movies were hit or miss.
The parks were the ATM.
The parks were the ATM. DeMauro is the guy who kept that ATM full. So by elevating him, the board is signaling that they are prioritizing the physical, tangible experience economy over the risky digital bets.
But here's the thing that makes me skeptical about a new era. Bob Iger isn't actually leaving, is he?
Not really, no. And this is classic Disney Palace intrigue. Iger is staying on as a senior advisor through the end of the year. Plus, they've moved Dana Walden into the president and chief creative officer role.
Okay, so you've got DeMauro running the business.
Walden running the creative.
And Iger hovering over both of them.
Yep.
That sounds like a recipe for a very crowded kitchen.
It's an orderly transition on paper, but it keeps the old guard very much in control. It's evolution, not revolution.
Now, if you want to see what a messy transition looks like, we have to look at PayPal. Because that didn't feel like passing the torch. That felt like someone dropped the torch and set the curtains on fire.
It was brutal. PayPal shares tumbled nearly 20% today. CEO Alex Chris is out, replaced by Enrique Lores, who's coming over from HP.
Hold on, a 20% drop. Companies change CEOs all the time. Was the market that attached to Chris?
No, the market didn't panic because of the name change. They panicked because of the guidance. Investors were expecting PayPal to show about 8% profit growth for 2026? Instead, the company came out and said, actually, profit is going to be flat.
Ouch. Flat growth in tech, especially fintech, is basically admitting you're dead, isn't it?
In this interest rate environment.
Yeah.
Absolutely. It's a signal that they have no new growth levers to pull, and bringing in a CEO from HP, a legacy hardware company, that just reinforces the narrative that PayPal is no longer a growth stock.
It's a value stock.
It's a value stock. It's becoming a utility, not a disruptor.
So PayPal is struggling to figure out what it is. Meanwhile, Walmart seems to know exactly what it is, and the market loves it. They just crossed a massive milestone today.
The $1 trillion market cap club.
That is just a staggering amount of money for a company that sells groceries and lawn chairs.
But that's the trick. They aren't valued at $1 trillion because of the groceries. Margins on milk and eggs are razor-thin pennies on the dollar.
Right.
Investors are rewarding them because Walmart has successfully morphed into a digital advertising powerhouse.
Wait, explain that. Walmart is an ad company now.
Think about it. They have the data. They know exactly what you buy, when you buy it, what you looked at before you bought it. They've built what's called a retail media network. They sell ad space on their website and in their apps to brands who want to reach you right at the point of purchase.
So when I search for laundry detergent on Walmart.com and I see a sponsored Tide ad, that's where the real profit is.
Exactly. The margins on that digital ad are like 70–80% compared to maybe 3% on the actual bottle of detergent. That is why they hit $1 trillion. They successfully consolidated the shopping experience with the advertising experience.
There's that word again, consolidation. Walmart is consolidating the ad dollars that used to go to TV or Google.
Precisely.
Let's pivot to the economy that actually hits our listeners' wallets.
Right.
We talked about cheaper chips earlier. This jumped out at me because usually here in 2026, the story is that everything just gets more expensive forever. But PepsiCo is cutting prices.
They are, and this is a huge aha moment for the state of the consumer. PepsiCo announced they are lowering the suggested retail prices for Lay's, Doritos, Cheetos, and Tostitos by up to 15% starting this week.
15% is a real cut. That's not a rounding error. So why are they doing this? Did they have a terrible quarter?
That's the fascinating part. They actually beat their Q4 revenue estimates. They brought in over $29 billion. But the volume, actual number of bags sold, was tricky. They hit what economists call the price ceiling.
People just refuse to pay $7 for a bag of air and cheese dust.
Essentially, yes. The consumer finally snapped and just said no. So this is a strategic retreat. They are sacrificing a bit of margin to get the volume back up. But remember, Pepsi sets the suggested price. It's up to the grocery stores to actually lower the price on the shelf.
So we'll see if the retailers actually pass those savings on or if they just pocket the difference. Meanwhile, if you want something to dip those cheaper chips in, McDonald's is doing something, frankly, kind of bizarre.
McDonald's marketing in the mid-20s has been distinct.
They are giving away McNugget caviar kits for Valentine's Day, February 10th. It comes with a $25 gift card. I have to ask, would you eat McNugget caviar?
I think I need to know what the caviar is actually made of first. Is it fish eggs or is it, little spheres of BBQ sauce?
I'm too scared to check the ingredients list. But it's getting people talking.
And that's the point. In a crowded fast food market where everyone is fighting for those same limited consumer dollars, sometimes weird is the only way to cut through the noise. It's a desperation play for attention.
Speaking of desperation, let's talk about the housing market. Because if people are too broke for Doritos, they are definitely stressed about rent. There are rumors swirling about a new policy, and the stock market reacted instantly.
This is the Trump Homes story.
Right. Reports are coming out about a proposed pathway to ownership plan dubbed Trump Homes. And just the rumor of this sent home builder stocks popping.
Immediately, Lennar and Taylor Morrison saw their stock prices jump significantly.
But I saw that D.R. Horton is weighing whether to participate. Does a massive national builder really want to attach themselves to a politically branded project? That seems like a PR minefield.
It is a risk, absolutely. But you have to look at the incentives. If the government is going to subsidize land or guarantee loans for these specific projects, that is guaranteed revenue in a shaky economy. Money talks louder than politics.
Yeah.
Investors are betting that the builders will hold their nose and take the cash to build the inventory.
So we have physical homes, physical chips, physical theme parks. Now we need to leave the physical world behind. We have to get into the sci-fi portion of today's deep dive. Segment 3. This is the stuff that makes me feel like 2026 is truly the future. Elon Musk.
The Musk mega merger.
He is merging SpaceX.
With XAI.
Right, with his AI startup ahead of a planned IPO.
This is the ultimate consolidation play. Think about the synergy here. SpaceX provides the body, the satellites, the rockets, the global infrastructure.
Sure.
XAI provides the brain, the compute, the reasoning, the navigation.
It sounds like Skynet, to be honest.
It's vertical integration on a planetary scale. By merging them, he creates a company that doesn't just launch satellites, but operates an intelligent network in space. However, it's not all high fives.
I saw that. Some minority investors are furious.
Rightly so. The criticism is about governance. If you invested in SpaceX to build rockets, and suddenly your capital is being used to train AI models, which is incredibly capital intensive and risky, you might feel like the terms of the deal were changed without your permission.
While Musk is building that powerhouse, other AI companies are causing some specific, tangible damage to traditional industries. We saw a story about Anthropic today that really scared me on behalf of my lawyer friends.
This is the Claude legal plugin story. It didn't get the front page headline, but it wrecked some stock prices.
Specifically, stocks like RELX and Thomson Reuters. These are the companies that own the massive legal databases, right?
Correct. For decades, their business model was, we own the case law, and lawyers pay us huge subscriptions to search it. Anthropic's new plugin changes the whole mechanism. Instead of a junior lawyer spending 10 hours searching a database billing $500 an hour, the AI does it in 30 seconds for 50 cents.
That just evaporates the billable hour?
And it destroys the moat of the database companies. If the AI can read and synthesize the law better than the search bar, why pay for the expensive subscription? That's why those stocks took a hit. The market sees their monopoly crumbling.
But, and there's always a but with AI, it's not all perfect efficiency. We have to talk about Moltbook because this story is wild.
Oh, Moltbook.
Yeah.
This is where the hype train derails.
It's billed as this AI agent social platform, right? A place where your AI talks to my AI.
That's the pitch. But researchers from Wired and Fortune have been poking around, and they found two massive problems. First, many of these autonomous agents are, well, they're just people.
Oh, hey, like the old Wizard of Oz man behind the curtain.
Exactly. It's the mechanical Turk problem. Companies are hiring low-wage human workers to pretend to be advanced AI bots to keep the illusion alive. But the second problem is technical and much scarier. Prompt injection cascades.
Okay, you need to explain that one to me like I'm 5. What is a prompt injection cascade?
Okay, think of the game Telephone, where you whisper a message down a line of people. Now, imagine the first person whispers a virus that makes everyone else sick. In an ecosystem of connected AI agents, if I feed a malicious command, a poison prompt, to one agent, and that agent talks to your agent, the virus spreads instantly. It can corrupt the whole network, stealing data, or executing bad commands, because the agents trust each other.
That sounds like a security nightmare.
It is. And it connects to the broader scrutiny we're seeing on OpenAI right now. The Saturday paper did a deep dive on their financials. The energy demands and capital costs to run these models are astronomical. It's not infinite magic. It costs billions to keep the lights on.
Speaking of keeping the lights on, the companies making the chips, the hardware fuel for all this, are having a weird day.
It's a very picky market. AMD actually had a great quarter. They made over $10 billion in revenue, but the stock slipped.
Why punish a company for making $10 billion?
Because traders want exponential growth, not just good growth. Meanwhile, NVIDIA is holding steady, and Supermicro is seeing bullish options flow, which basically means traders are placing heavy bets that the stock is going to shoot up soon. The demand for hardware is there, but investors are being very selective about who they trust to deliver.
So tech is volatile, but media is just going for broke. We mentioned consolidation earlier. This is the big one. Netflix buying Warner Bros. Discovery.
For $83 billion.
That number seems insane to me. $83 billion. WBD has so much debt. Why does Netflix want that headache?
It's about the library. It's the content fortress strategy. Netflix has the distribution there on everyone's TV. WB has the prestige content, HBO, Harry Potter, DC Comics.
Co-CEO Ted Sarandos is in front of the Senate today defending the deal. What is his argument? Because this just sounds like a monopoly.
His pitch is efficiency. He's telling the Senate, we can offer more content at lower prices if you let us combine. Who's trying to argue that this will actually help consumers by simplifying the streaming mess.
I'm skeptical that a monopoly ever results in lower prices for me, but okay.
The Senate is skeptical too. But for Netflix, this is the endgame. If they pull this off, they aren't just a streamer anymore. They are the television industry.
While Netflix tries to buy Hollywood, the rest of the market seems to be in a bit of a risk-off mood. We saw a tech-led sell-off today.
Yeah. The S&P and NASDAQ both took a hit. And look at crypto. Bitcoin sank to a 16-month low, briefly dipping under $73,000.
I have to laugh because back in 2024, if you told someone Bitcoin was at 73,000, they'd be popping champagne. Now it's a low.
Perspective is everything. But the options market shows people are nervous. They're buying downside protection around 75K. However, there is a glimmer of hope. President Trump hosted a meeting at the White House on stablecoins. They're trying to finalize the Clarity Market Structure Bill.
If that passes, does it fix the volatility?
It doesn't fix the volatility, no. But it gives institutional investors permission to enter the pool without fear of getting sued by the SEC. That's a big deal.
So crypto is shaky, but you know what's driving straight through the gloom? Waymo.
This is the counterpoint to the AI is hype narrative. While Moltbook is faking it with humans, Alphabet's Waymo just raised $16 billion.
$16 billion in one round.
Yes, putting their valuation at $126 billion. They are scaling robotaxis aggressively. This tells us that despite the market jitters, smart money is still betting huge on automation that actually works in the physical world. It's not a chatbot. It's a car that drives you to work.
Before we wrap up, we have one more thing. We talk snacks, we talk tech, let's talk about health. If you ate too many of those discounted Doritos, Pfizer has some news for you.
They do. Pfizer is finally entering the weight loss arena properly. They reported mid-stage data for a new GLP-1 injection.
Okay, for the listener who hasn't been tracking the pharmaceutical dictionary, remind us what GLP-1 is.
Sure, GLP-1 is a hormone mimic.
Yeah.
Basically, it tells your brain, hey, we're full, stop eating, and it slows down your digestion. It's the mechanism behind Ozempic and Wegovy.
But Pfizer is late to this party. Why do they think they can compete with Eli Lilly and Novo Nordisk?
2 words, monthly injection.
Oh, that is a differentiator. The current ones are weekly, right?
Exactly. And needle fatigue is a real thing for patients. Pfizer's data show 12.3% weight loss at week 28 with just 1 shot a month. If they can bring that to market, the convenience factor alone could make them a massive player.
So what does this all mean? We've covered a lot of ground today. We have cheaper chips for snacking, expensive chips for AI, new bosses at Disney and PayPal, and rockets merging with robots.
If you look at the big picture, the theme really is consolidation and reality checks. Whether it's SpaceX absorbing XAI to control the future infrastructure, or Netflix trying to swallow Warner Bros. Discovery to own the past's content library. The big players are circling the wagons. They are building fortresses.
And for the regular person, for you, the listener,
It's a messy time. The companies that are faking it, like the human-run AI agents, are getting exposed. The companies that are lost, like PayPal, are getting punished. And the companies that have real, tangible leverage, like Walmart with its ads or Waymo with its cars, are winning.
here is a provocative thought to leave you with. We have Trump homes, rumors, moving stock prices instantly based on a policy that doesn't exist yet. We have human agents on Moltbook fooling users into thinking they are talking to the future. In 2026, where does the line between buzz and reality actually sit? Because it feels like the market is trading on stories just as much as it's trading on facts.
That is the trillion-dollar question. As long as the story is good, the market seems to buy it until the bill comes due.
Indeed. Well, go enjoy your discounted Doritos if you can find them on the shelf. Keep an eye on those charts, and we will see you in the next deep dive.
Goodbye, everyone.